Let's also welcome on board Saurabh Mukherjea then. Saurabh, hi. Morning. The MPC meet kicks off today with the GDP at a 6-year low. You think it's a given that for a sixth time, the RBI would be cutting rates?
I think they'll be cutting rates. I hope they cut by 25 bips rather than 15 bips. But I think also we should also recognize, given the fiscal situation, given how high government borrowing has become, we should also recognize that rate transmission is going to be muted. But it'll be astonishing if, given the economic weakness all around us, the MPC doesn't cut rates.
Really, and try and pick up or kick up the economy then, Saurabh. If the rate transmission is not going to happen, the RBI can continue cutting rates. That's not really going to reflect in the real economy as it is.
Yeah, that's right. So I think as we have discussed on your show before, what we need is the government to continue pushing reforms from Delhi. I was and I remain very hopeful of land and labor reforms. It was extremely encouraging to see the government table in Parliament last week what looks like the beginnings of the labor reform process. I think government proposed and tabled in Parliament last week a bill which allows companies to employ people for fixed terms. And if this labor reform process continues through the winter and is accompanied by land reforms in, say, the budget session of Parliament, I think that's as good a tonic as we can get after the 15% tax rate. If the budget should contain middle-class tax cuts, once you've cut corporate tax rates by this amount, cutting middle-class taxes would also make sense. A combination of tax cuts, land reform, labor reform, difficult to see what more the government can do on the reform front. If we can get that, I think that'll be far more tangible as a kicker to the economy than RBI rate cuts.
Okay, what about if we see something on the income tax slab, Saurabh? It seems that the government may be mulling some measures there. Still a big if and when, but do you expect to see anything, or are you counting on seeing any stimulus from that end?
Look, from a fiscal arithmetic perspective and from an economic stimulus perspective, it makes sense to give people lower down the income spectrum greater tax relief. Whether you do that by cutting the tax rates or by increasing the slabs, I think is a matter of detail that the government, I'm sure, will be on top of. But I think giving people at the 5 lakh, 10 lakh, 15 lakh income levels greater tax relief is a far more potent economic stimulus than trying to, say, give people like you and me tax breaks. So my reckoning is there will be middle class, lower middle class tax breaks coming through in the budget. Only question is, extent and how much fiscal hit the government is willing to take. Will that be accompanied by GST cuts? I think that is the big question I don't have answers to. There is talk that there might be rationalization of GST. I hope there is, because it is relatively clear that the GST structure is a little too complicated out there. So if we can rationalize GST, so which is indirect taxes, bring down direct taxes for individuals alongside the already announced corporate tax rates, I think that will probably amount to the biggest scale back in Indian taxes for a long time. That obviously imposes fiscal cost, which is where we go back to the privatization. If the BPCL privatization goes through even in the next 6 months, that will be the biggest privatization in nearly 20 years in our country. So there's lots happening. There's enough there for the market to sort of, chew upon and mull upon, even as the economy struggles.
Right. Saurabh, what is it that you're making of the fundraising activity that one has seen both with RBL Bank and Yes Bank, and typically how circumspect the market has been on who the investor is who's putting in money?
So I'm not so sure that the fundraising activity is yet signaling a turn in the cost of capital cycle for our lenders. I think for the last year and a half, I've been very circumspect on both private banks and NBFCs, especially private banks with the weaker CASA franchises. I'm not so sure the market is yet signaling a great deal of enthusiasm in injecting money with banks whose CASA franchises are weak and whose credit selection has been pretty questionable. We're not there yet. Perhaps another 6 months of economic reforms, we'll see a much healthier fundraising climate for our private sector lenders.
All right. Saurabh, what are you making of the entire unfolding of news in the telecom space, some respite, of course. Does it make you take note of the sector once again? Do you feel that they'll manage to get themselves out of the current mess, or does it still look incredibly bearish for the next few years?
I think in a way telecom is the classic example of what the rest of our economy and the rest of our stock market is going through. We are ending up concentrating pretty much every sector into the hands of one or two players. I think telecom is heading towards a duopoly type situation. Similarly, if you take private sector banking, or indeed NBFCs. In private sector banks, you have two very strong private sector banks. In NBFCs, you have one or two very strong NBFCs/HFCs. Right? This concentration of economic power into the hands of one or two champions, whilst the rest of the sector struggles, I think becoming the defining hallmark of our economy and therefore our stock market. I used to sort of believe that this was limited to sectors such as FMCG, so say for instance paints or cooking oil or biscuits, but it now seems to be spreading towards the broader economy. That obviously means that we are ending up with one or two big winners, massive winners where you can make lots of money, and then lots of small companies who fall by the wayside, to the detriment of their shareholders and to the detriment of their employees. So it's a very new phase of capitalism in our country, where one or two people take away the riches from the sector and the rest of the people are left holding very little.
Sort of an interesting note by JP Morgan this morning, and they're saying take profits in the ongoing resolution trade. They're talking about the financial sector. They're saying that the key challenge for the sector is credit growth and earnings as well as ROE visibility, and they're saying that this will limit valuation mean reversion trend. Having said that, they continue to be bullish on the top brass of the financials. But do you believe that time's come to be a little more selective within financials? Because just a short while back, one thought that the participation is getting a little broader within financials, but do you think that's just a near-term phenomena at best?
Yeah, so for the 11 years I've lived in India, I've always believed it is worthwhile being selective in Indian financials. We have a very few cautious, conservative lenders who use their shareholders and their depositors' money wisely. For better or for worse, we have more cowboys than cautious lenders in our financial services sector. What's happened is, because of the tightening of capital markets, the concentration of market share in the hands of the cautious lenders is increasing rapidly. So say Bajaj Finance and HDFC on the non-bank lender side, and to use two prominent examples, HDFC Bank and Kotak Bank on the private sector bank side. So when capital market conditions are tight, the concentration of lending activity in the hands of a few lenders becomes more pronounced. Now this has actually very profound ramifications. If you assume that in the next 10 years credit growth in our country will be say 10% as opposed to 13% in the preceding decade, just assume 10% credit growth and assume that, taking for instance HDFC Bank's market share goes from the current 7%, it just has 7% lending market share, to say 10% a decade hence. What that's telling you is that with a pretty high degree of probability, you're likely to see HDFC Bank becoming 10 times larger than it is today 10 years hence, right? So all we are assuming is significantly lower credit growth in the next 10 years than in the last 10. We're assuming HDFC Bank's market share goes from the current low 7% to 10%. Just that modest level of economic activity gives you a lender which is 10x larger 10 years hence, a lender which will be significantly larger than what a bank like JP Morgan, which is the world's most valuable bank, a lender significantly larger than what JP Morgan is today. So if you take the changes in our country and see the longer picture, it gives you a very clear picture of a few giants who make lots of money for their employees, for their shareholders, for their stakeholders, and then lots of smaller companies who are not able to deal with this far more difficult phase of capitalism that we are undergoing in our country.
Okay, fair enough. Saurabh, do you see any kind of, in the sense that given that we're already trading at these levels and there's no near-term stimulus, do you see things perhaps being in some kind of status quo until and unless we hear something from the budget, or do you expect to start to see signs of that turnaround as early as next year?
So I think status quo is going to be hard to maintain. I think whichever way we look at it, given how stressed the economy is, I reckon the government will keep its foot firmly on the reform pedal. There's no elections in the next 15, 16 months, right? So there's no reason why the government will take its foot off the reform pedal. And if the government keeps its foot on the reform pedal, on land reform, on labor reform, on tax cuts, I reckon we should see an economic recovery next year. But the stock market's already beginning to discount that. It was discounting, I think it is discounting it a little bit indiscriminately in all sorts of, again, weaker companies. As you were, I think, just mentioning, some of the weaker companies were rallying once again with no apparent justification. But as the reform process bears out, I think the stock market will discount a recovery. And my reckoning is it will discount the recovery in terms of saying, here are the best franchises to play if we see a leaner, meaner, more efficient Indian economy over the next 5 to 10 years.
All right, fair enough. And in terms of anything else that's on your radar currently, I mean, I know you have the portfolio that you usually track, but anything else that's catching your eye or that you're just observing from a near-term perspective to see if we perhaps might see signs of that recovery in?
So I think we discussed auto and auto ancillaries on your show for the last, I think, a couple of months. My view is increasingly getting stronger that it does make sense to play the best auto OEMs in terms of ROCs, cash generation capability, franchise strength, to play them ahead of the numbers kicking. And I don't think the auto numbers are yet showing any significant recovery, whether it's for trucks, cars or motorbikes. I reckon two-wheelers will come back quicker than trucks will. Trucks, because of the sheer ticket size, will take longer. So I think it makes sense for people to look at the two-wheeler OEMs and choose one where they think the probability of a decisive recovery is greatest. So in some of our clients' portfolio, we've bought some Eicher motors over the last month or so, given the strength of the Royal Enfield franchise. And we're looking for more bargains in the sector, looking at the OEMs as well to see amongst the OEMs who has strong, high-quality franchises, great relationships with the dealer-distributor community. And given where valuations are, I think there's at least going to be one or two bargains in the auto OEMs that will come through quite strongly in the next couple of years.
Saurabh, great to have you on the show. Thank you so much for taking the time out and stopping by.